Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next presentation from PointsBet Holdings Limited, a cloud-based wagering platform. Please note you can submit questions in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I am very pleased to welcome Andrew Meller, Group CFO of PointsBet Holdings Limited, which trades on the OTCQX Best Market under the symbol PBTHF and on the ASX under the symbol PBH. Welcome, Andrew.
Thank you very much for hosting us today. I'm Andrew Meller. I'm the Group CFO of PointsBet, and today I'm looking forward to presenting our PointsBet 2.0 strategy and a little bit of history of the company. PointsBet was listed in Australia back in 2019, and for those that have followed our story, we grew an Australian business to profitability. We launched a US business, which was recently purchased by Fanatics Betting and Gaming, and I'll speak to that in a moment. And we have a Canadian business that we launched in April of our last calendar year. But a little bit of background on PointsBet and what our strategy to date has been. The key from a PointsBet perspective and a strategy was always owning your own technology. We've built and developed our technology on very modern code with an elite team of technologists across Australia, the US, and Canada. 2 years ago, we bought a company in Ireland called Bannock Technology, and that has supercharged our in-play betting experiences. And I'll speak a little bit more in depth around the technology and why that's so important in modern online gaming, particularly sports betting and in-play sports betting. The business has grown an Australian business to profitability. As I mentioned, we've just reported our fourth consecutive year of positive EBITDA in Australia. The Canadian business offers a significant amount of growth potential for the business. Canada just legalized sports betting. It launched in April of 2022, and it's a nascent market. It offers both iGaming and sports betting, which is slightly unique to a lot of the states of the US. We operate in 14 states of the US, and only 4 of those states offered iGaming. And I'll speak a little bit later to the importance of that. And as I said, we've exited our US business. We built a business where we operated in 14 US states. And recently, back in May, we announced the sale of that business for $225 million to Fanatics Betting and Gaming. And I'll shortly explain what that means for the company and for its go-forward strategy. But what we retain, obviously, is a very well-capitalized company with a highly experienced global gaming team. And really importantly, the business will be EBITDA positive from FY25. We certainly anticipate that. And that's a big change in the strategy from where we were a growth and pretty highly loss-making company previously to that. As I said, just to update on the sale of the US business, it was obviously a big part of our strategy. It was a big part of the capital that we'd raised over the journey. And we're really proud of what we achieved in the US, operating in those 14 sports betting states and 4 iGaming states. But now with the sale of that business for $225 million to Fanatics Betting and Gaming, which is circa 333 million Australian dollars, the company has a new strategy, which entails Australia and Canada. And obviously, we'll end up with a decent amount of capital on the balance sheet. We ended the financial year 30 June 2023 with $200 million of corporate cash, and we'll be receiving circa 333 million from Fanatics through 2 closing processes. So the board and management has decided to do a capital return to shareholders of a total of between $1.39 and $1.44 per share. We've already announced the return of the first dollar. It'll occur in 2 stages. So the first dollar will be paid on the 22nd of September, and the stock is now trading ex that dollar. The second distribution between 39 cents and 44 cents we anticipate will happen in Q1 of calendar year 24. We've gone through the relevant shareholding approvals for the sale and for those distributions. And so we're in a transition period as a company. As I said, the stock is trading ex the dollar, but we'll have a second distribution of 39 cents to 44 cents per share as we now roll the business out of the US and continue to focus on the Australian and the Canadian businesses. Just to quickly talk about technology, it's the core part of the strategy. It's a big part of why the Fanatics Betting and Gaming bought our US business. What we've built is market leading. In the US, our app has been ranked for the past 5 quarters by Eilers & Krejcik, who is one of the leading independent gaming analyst firms in the US. For the past 5 quarters, we've been ranked in the top 3 apps in the US. So there's approximately 40 plus operators in the US. 1, 2, and 3 for those past 5 quarters have been FanDuel, DraftKings, and PointsBet. That was certainly our strategy. And as I mentioned earlier, the acquisition of Bannick Technology in 2022 did supercharge our in-play betting capabilities. And obviously that's a very, very large part of the US market and the Canadian market, importantly. But what that is, in simple terms, is one global platform with a single code base. And as I mentioned earlier, a very modern code base. This technology has been developed just for the last 6 or 7 years. So rather than operating on technology that has been around for 1 or 2 decades, this is as modern as you get and continues to be developed in a scalable and secure way. Outstanding UX and UI. We have a very key part of our strategy is being as close to our client as possible, understanding what our client wants and needs. And most importantly, it's proprietary algorithms. This is owned by PointsBet. And the important part of the sale of the business to the Fanatics Betting and Gaming is that they take that technology, which was a big part of the reason they bought our US business, but we also get to keep it. It's very neat. We actually get to keep a cut of that code. So we'll take the code at the final closing date. They'll take their version, we'll take our version, and then each company is able to then go and exploit it and develop it in their own particular way. But that in-play excellence was key. Key for our product features, as I said, key to be as close to your client as possible. And importantly, it includes iGaming because that's a very important part of the market in Canada and globally around the world. Just to quickly run through the key operational highlights. As I mentioned, we retained our number 3 ranking in the Eilers & Krejcik app testing. The business has continued to develop the Odds Factory, which was formerly Bannick. Live betting in Canada represented 63% of our handle. So bets that are taken after the start of a game represented 63% of all bets. That's up from 63%, up from 53% in 22. Very, very important part. When the majority of your handle and your betting occurs after the start of a game, excelling in the ability to manage those changing odds as a game is continuing in play is crucial and very important. Our Australian business, which I'll go to in a little bit more detail, had a transition year. We were down 2% on a revenue perspective. There was certainly some adjustments from the previous 2 years where the industry had a lot of tailwinds from COVID, where everybody was locked down. That saw some normalization. We did outperform the market from a growth perspective. The market was down 5 to 7%, and we were down 2%. But really importantly, in Australia, you're able to bet on fixed odds racing, which is thoroughbreds, greyhounds, and harness. That had a bit of a softer period through the year, but importantly for us, we saw a decent amount of growth in our Australian sports. AFL, Australian Rules Football, and NRL, the rugby leagues, that increased 86% versus the PCP in FY23. And importantly, also tennis and soccer increased 53% versus FY23. So I think it's very, very important to see that the nature of the Australian business is changing. I'll speak to that in a moment when we talk to Australia more specifically. And then importantly in Canada, as I mentioned, iGaming in the US only existed in 4 of the 14 states we operated in. whereas in Canada, in Ontario, the only province currently legal for sports wagering and iGaming, iGaming sits beside sports betting, and you'll see how important that is in terms of the numbers, as I speak to in a moment, where iGaming represented 62% of the Canadian total net win or revenue. So overall, the group was up 7% versus the previous year on a net win basis, and cash actives were up 9%. And turning to slide 7, I just want to walk you through now the normalised continuing operations P&L. When we reference continuing operations, that is the operations of Australia and Canada. The consolidated includes the US, which is the business that we have sold. So continuing operations is the numbers to focus on today. As you can see, for FY23, net revenue was 210 million, gross profit 105 million, which is about a 50% gross profit margin. And then the major expense items being sales and marketing expense of 90 million, employee benefits of 39 million, product and technology of 14, and administrative and other expenses of 10, which was an overall loss for the financial year of $49 million on an EBITDA basis. Importantly, though, we've given some really strong and guidance as to what the operations look like in FY24. And I'd just like to walk you through that today. Firstly, we expect that net revenue is going to grow on a group basis between 10 to 20% in FY24. We expect our gross profit margins to be consistent at around 50%. And really importantly, on the marketing expense, as I said, in FY23, that was 90 million. Australia was 61 million and Canada about 29 million Australian dollars. We expect both of those to fall by 15 to 20% in FY24. And really that saving does go straight down to the bottom line. We don't expect that to impact our actives. We expect actives to grow between FY24 and FY23. But what we've noticed is we did find some wastage in some of the spend through FY23 in Australia, where it was very competitive in the first part of the year. And in Canada, we used some third-party providers from a setup perspective of marketing that we won't be using into FY24. So that those savings we see is not impacting actives, and obviously the savings going straight to the bottom line. Employee benefit expense did increase versus FY22, mainly as a result of the Canadian employee benefits expense being recognised for the first full year. We've also given some overall guidance on what that OPEX looks like in 24. The employee benefits expense, the product and technology expense, the administrative and other expenses. We see those in 24 being between 60 to 70 million dollars. And when you think about the cost out from the business, you can see what the consolidated would have been with the US business included. So down from sort of 170 million to 60 to 70 million. So there's a significant amount of cost out that's come as a result of the sale of the US business. So those are really important numbers, and I'll speak to them a little bit in our conclusion. I'll now just touch on the Australian trading business and the Canadian trading businesses, their operational and trading metrics. As I mentioned earlier, the Australian trading business net win was down about 2% on the previous year. A big change occurred through that cycling out of COVID, as mentioned. But we're really pleased overall with the overall margins, a gross win margin of 11.7% and a net win margin of 8%. But really importantly, sort of digging behind some of those numbers. I've already spoken to the NFL NRL and AFL and tennis and soccer growth. But the promotions efficiencies is significant. Promotions efficiencies are the difference between the gross win and net win. And you can see the promotions as a percentage of gross win in 2023 was 31.5%, down from 36.3% in the PCP. And that promotional efficiency is very important as to how you allocate promotions to clients and which clients get promotions and those that don't. And we've really invested heavily in the technology in and around that. And we've got some more improvements to come. But that'll allow us to ensure that the promotional spend is reduced as a percentage of the gross win over time. The other thing I just wanted to touch on this slide was the third last bullet point, the mass market client base. Mass market are sort of the non-managed clients, and they've they've delivered in FY23 a growth of 15% in net win versus the PCP. And that's very important because that shows you have less reliance on some of your higher and wealthier clients, higher spending clients. And so you want to move towards a more mass market business over time. And certainly that growth offsets some of that volatile managed or VIP segment P&L through the year. And turning to Canada, obviously this is a little bit more of the growth engine of the company. Canada only operated in FY22 for the last quarter, for that June quarter. So this is you can see certainly large growth, but a lot of it is versus only a quarter of operations in 22. I mentioned earlier, but want to reiterate, the in-play mix of sportsbook handle grew to 63%, up from 53%, very, very important part of the business. And as I mentioned, marketing expense we expect to fall from the 26 million Canadian by about 15 to 20% in FY24. The other thing to highlight here, though, is how important iGaming is. We are a sportsbook-led brand. We acquire our clients through their love of sport and our superior sports product. But you can see the importance of iGaming sitting next to sportsbook, where iGaming delivered 11.5 million of the 18.3 million in total net win. Just to start, towards the conclusion, you can see on the left-hand side, this is how business looks like going forward. We have a very strong Australian business. It's profitable. It's been profitable for 4 years. And the fall in marketing expense, as well as what we will believe is going to be top-line growth, we'll see an improvement in the EBITDA. We have strong brand recognition in Australia, and we're really well positioned, we feel, to manage what is a little bit of an evolving regulatory environment here. Canada, we have the number one sports betting product, certainly tier one. We've got a growing position in the market, and just to speak about Canada, it's a very different market to the US. The unit economics in Canada are slightly adjusted towards what we saw in the US. The tax environment is very fair for the operators. You've also got a situation where the competitive nature is slightly adjusted. You don't necessarily have a FanDuel or a DraftKings dominating the markets. They're still strong competitors, but they don't dominate the markets like they do into the US. And you don't have to pay partner fees to access the various states, like many of the states in the US. In the province of Ontario, you're licensed directly through the local regulator. So there's definitely some regulated TAM expansion to come, but we feel like the investment we're making in Canada will pay dividends in years to come, and everything sits on top of the technology. The technology is key to success in this business, and we feel that we've built a market-leading product, and we certainly are not going to stop investing there. The investment will continue. It won't be the same investment as the one we had into the US. It'll be slightly adjusted, but we really feel that we've got a really highly proven platform for regulated markets. We have a strong iGaming platform with improvements to come, and that'll all deliver top-line growth. We've talked about reducing costs. We now have a clear path to profitability in FY25 and are certainly well capitalised post the US sale and post the capital distribution to our existing shareholders. And just to conclude on the financials, as I said at the start, we anticipate to deliver positive group EBITDA in FY25. Our top line, our net win, we expect to grow 10 to 20% in FY24. We expect our marketing expense to be 15 to 20% lower than FY23. The company expects the normalised operating expenses to be between 60 to 70 million, and we expect to be at or close to break even from April 2024. And that's really the important factor. It's a big change from what was the original PointsBet, where we had the US business. And whilst I said we're very proud of what we've achieved in the US, we're excited about what our team and technology can do together with the Fanatics as they take that business forward. But now we have a much more stabilised operating environment. We have a great opportunity in Canada with a mature business in Australia. And now I'd like to hand over for some Q&A. We've had a couple of questions come through that I'm more than happy to answer. The first one is if you could describe the competitive environment in both Australia and Canada. Two very different markets, and thank you for the question. Basically, the Australian business has had legalised sports wagering since circa 2008, online sports wagering since 2008, so is relatively mature. In Australia, PointsBet has a 5% market share, and we're the fourth or fifth largest player. And so the largest player has about 45% market share, the second largest circa 25%, the third largest about 15%, and then PointsBet, together with Bet365, each have around about 5% market share. So you basically got 5 to 6 operators really dominating the market in Australia. In Australia, in-play sports betting online is not legal, and iGaming is not legal. But what is legal is betting on horses through thoroughbreds and harness, and on greyhounds. And so that forms a big part of the business in Australia, but the majority of the betting is all pre-game. And so that's a slightly different model than what you see in the Canadian market. We're very excited about the opportunity in Australia and our place in the market. And so we plan to continue to grow that market share over time. Canada is different. There's a number of different players, and because you have sports wagering sitting beside iGaming, there's actually a number of operators that just do sports wagering, a number that just do iGaming, and those that cross over both. We cross over both. We find it's a very important way to offer your clients the full spectrum of product offerings, both on sports wagering and iGaming. And there's no doubt that it is a competitive market. Some of the former grey market operators are now operating in the regulated market. And of course, the operators such as FanDuel, DraftKings, MGM do have a big presence in the market and are strong competitors. But we certainly feel we competed well against them in the US and now into Canada. So the other piece to the Canadian market is that the capital required to invest and run the business there is significantly lower than the US. And we're certainly taking a capital light and a strategic operating environment into Canada. And we feel that Canada's really on that path to profitability in potentially FY25. So that hopefully answers that question on the competitive environment. Next question is to discuss the cost savings post the exiting the US business. We had circa 250 plus staff, and the SaleCo perimeter for the US business is the US and the Irish staff. And in totality, that was about 250 people that will move across to the Fanatics. And obviously there was large marketing investments that we've made into the US, and really pleased with the results we got from that. But certainly large savings. And I referenced earlier that the consolidated group, including the US, had operating expenses excluding marketing of circa 170 million. Whereas if you exclude the US business, we expect it was around 65 million, and we expect that to be 60 to 70 million in FY20 in FY24. So there's some significant changes from what was a larger cost base running the business to a more nuanced and capital light model. The last question is just what are the group milestones for the next 12 months? So it really goes back to that last slide. I think we really want to deliver on the numbers that we've guided to: revenue up, marketing down, actives up, consistent operating expenses, and that really will hopefully allow us to achieve that profitability in FY25, but before that run rate profitability from April 2024, which we've spoken to. So that concludes the questions. I'd like to thank you for joining today, and please do reach out through OTC if you have any further questions.